pull that chair out a little more. Yeah, just get comfortable. Here, let me take that plate. I'm going to carve a few slices of this slow-roasted pork shoulder for you. I've had it in the oven, low and slow for the better part of the afternoon.
Oh, it smells incredible in here.
Yeah, I want you to get a piece right from the center where it's perfect. Pass the Sunday gravy down this way, too, would you?
Here you go.
Thanks. Look, it is genuinely good to have you at the table tonight. You've been running yourself absolutely ragged lately, and, well, it shows. I know you just passed your SAFE exam, you've got that shiny college degree up on the wall, and you're feeling pretty good about stepping into your career.
And you should be. You earned it.
You absolutely did. I'm proud of you. I really am. But, I am going to shoot you straight right out of the gate here, because that's what we do at this table. Book smarts and a fresh license are fantastic, but they will not save your balance sheet in this current market. You are stepping into an incredibly complex, rapidly shifting economic landscape.
Pass me that basket of garlic bread, would you?
Oh, God.
And pass a piece over to our guest here. You know, you're absolutely right. Listen to me. Between the two of us sitting across from you at this table, we have over 30 years of experience in the financial trenches.
Over 30 years, we've seen it all.
We were originating loans and managing risk when the dot-com bubble burst. We navigated the absolute systemic meltdown of 2008.
Yeah.
And, I mean, we managed the completely unprecedented madness of the pandemic era. We've seen the cycles. We've seen the tricks, the traps, the illusions.
The illusions, yeah, that's the perfect word for it.
Right. So the mission of our conversation tonight, this deep dive into the grand scheme of the economy, is to share the absolute ground truth with you. We are doing this because we care deeply about your long-term solvency. The mainstream media right now is feeding you a daily diet of fragmented noise, political spin, and localized panic. You need to learn how to completely tune that out.
That is exactly it. You have to ignore the surface noise. What we are doing tonight is a horizon scan. We are going to take all the global and domestic news, the massive geopolitical shifts, the obscure regulatory changes buried on, page 12 of the financial papers, the technological disruptions, and we are going to translate them for you.
Connect the dots.
Exactly. We are going to show you exactly how the macro world is drawing a direct line to your personal wallet, because none of this is theoretical. When we talk about global trade or central bank policy, we are ultimately talking about the cost of your groceries, the security of your W-2, and the mortgage on your future home. So eat up, get comfortable, and really listen. The world is moving incredibly fast right now, and you need to see exactly what we see.
Let me pour you a glass of this Barolo wine. It needs to breathe a little, but it's fantastic. Let's start our scan by looking overseas first. Because the hardest lesson to learn in finance is that what happens thousands of miles away dictates the baseline cost of your life right here in your own neighborhood.
It's the butterfly effect, but with money.
Yes, exactly. As of March 1st, 2026, the entire geopolitical board just flipped over. The United States and Israel launched a massive, coordinated surprise kinetic attack on Iranian targets. And I want to be clear about the scale here. This wasn't a border skirmish or a proportional response. Supreme Leader Ali Khamenei was assassinated. It was a decapitation strike that fundamentally removed the top layer of their strategic command.
Stop right there, because I want to make sure we unpack this for you. When you hear kinetic attack on the news, it's easy to detach from it. It sounds like a movie plot. But the immediate shockwaves are very real, and they are actively restructuring global risk. In Iran, they immediately activated Article 111 of their constitution,
which is their constitutional contingency for when the supreme leader is incapacitated or removed.
Right. So they've installed a transitional council. It's a provisional triumvirate consisting of President Masoud Pezeshkian, Chief Justice Gholam Hossein Mohseni EJ, and a jurist from the Guardian Council. At the same time, Ali Larijani has stepped in to consolidate emergency security powers. They are doing everything they can to project absolute state resilience and continuity of government to the rest of the world.
But behind that projection, the entire region is essentially on fire.
Absolutely on fire. Look at the United Arab Emirates. The UAE is traditionally the financial safe haven of the Gulf. It's the Dubai Tech Hub, the Abu Dhabi Capital Center. Right now, the UAE government is issuing emergency alerts to millions of its residents. Imagine sitting in your apartment and your mobile phone lights up with a government mandate telling you to seek immediate shelter from inbound retaliatory missiles.
They literally have advanced air defense systems intercepting projectiles in the sky over major commercial and financial hubs right now.
And you have the UN Secretary General standing at the podium condemning the strikes, warning that the entire Middle East is spiraling into a multi-theater confrontation. But let's bring this massive global event right back down to this dinner table. You might be sitting there wondering, why does a missile intercepted over the UAE affect my bank account in America?
It matters because this is effectively a hidden war tax levied directly on your household. Global energy markets react to risk instantly. We are looking at the potential weaponization of the Strait of Hormuz.
Break that down for a second. The Strait of Hormuz. We hear that name tossed around on the cable news networks constantly, but what does it actually mean for the math of a household budget?
The Strait of Hormuz is a geographical choke point. It is barely 2 miles wide at its navigable channels, and roughly 20% of the entire world's daily crude oil supply passes through it. It is the jugular vein of the global energy market.
20%, that's massive.
Right. So when a conflict of this magnitude erupts, insurance premiums for oil tankers skyrocket. If that strait gets blocked, or even if the market perceives a high probability that it will be blocked, the price of Brent crude oil is projected to target the $90 to $130 per barrel range.
Have some more of these ZDs. Just think about how that energy squeeze trickles down. Everything you buy, everything sitting on this table right now, had to be transported. When fuel costs surge, the cost of the logistics chain surges, and those costs are passed directly to you at the grocery store checkout.
And look at the bizarre dynamics happening with OPEC Plus right now.
Oh, the unwinding. Yeah.
The cartel just announced they are unwinding their 1.65 million barrels per day production cuts starting in April. They are essentially agreeing to pump more oil. But simultaneously, the UAE is raising petrol and diesel prices at the pump in March, strictly due to the regional tensions we just talked about.
It's a massive disconnect. You have the oil cartel trying to defend their global market share by increasing supply, but the geopolitical risk premium is so severe that it's overriding the basic laws of supply and demand. The risk of war is making the oil more expensive before it even comes out of the ground. Energy costs dictate the baseline cost of absolutely everything you consume.
And this energy crisis ties perfectly into the broader friction we are seeing in global trade. I was reading a recent report from UNCTAD.
The United Nations Conference on Trade and Development.
Yes, the UNCTAD report. It maps out how aggressive U.S. tariffs combined with these localized military conflicts are violently redrawing the global trade map. It is absolute chaos out there. We are seeing supply chains being actively weaponized.
Give an example of that because the numbers are wild.
Well, the report noted that South African wine suddenly became 17% more expensive on the global market, while Italian rice dropped 12%. These aren't normal market fluctuations. These are the results of nations throwing up protectionist walls and rerouting entire shipping lanes to avoid war zones.
Speaking of Italy, look at what is happening to the European economy. The Confindustria Flash report, which is basically a real-time health monitor for Italian industry, shows their economic recovery is severely faltering.
Because of the export drying up.
Exactly. They rely heavily on exports, and their export markets are drying up, combined with those sky-high energy costs we just talked about. As a result, Italy is facing massive nationwide transport strikes throughout March. We are talking about aviation workers, public transit operators, freight handlers. Labor unrest is completely paralyzing the country.
And the root cause is that the real wages of the Italian working class are being absolutely destroyed by inflation. They can't afford to live, so they strike.
But then you have to look at the other side of the coin to understand how strange this macro environment is. Hand me that salt shaker, would you? Thank you.
Yeah.
Look at the absolute paradox of the global economy right now. You have Ukraine, a country that has been under relentless, grinding, kinetic bombardment for years. They are enduring severe power cuts. Their infrastructure is constantly targeted.
And yet, the National Bank of Ukraine is officially projecting that their economy will actually grow by 1.8% in 2026.
That sounds mathematically impossible. How does a nation grow its GDP while its power grid is being actively dismantled?
It's a fascinating combination of factors. First, you have massive, constant military spending, which acts as a brute force economic stimulus. Second, they've managed to maintain their agricultural export corridors despite the conflict. But the most important factor, and the one you need to pay attention to, is how ruthless their central bank has been.
The interest rates.
Yes. The National Bank of Ukraine incentivized domestic savings over consumption by hiking interest rates to between 13 and 17%. They essentially force their population to stop spending and start saving by making the yield on cash incredibly attractive.
So what is the takeaway for you, sitting here safely at Sunday dinner, eating slow-roasted pork? The So what is a lesson in resilience and positioning? If the Ukrainian economy can find a way to grow 1.8% during an active existential war, you can absolutely figure out how to navigate a tricky domestic job market. But you cannot do it by relying on the old rules. The rules of the game have fundamentally changed.
Exactly. You must understand that global conflict permanently elevates the baseline cost of capital. Let me walk you through the mechanics of this because it's vital. When missiles start flying in the Middle East or Eastern Europe, foreign investors get terrified. They take their money out of risky assets, and they hoard United States treasuries because U.S. government debt is viewed as the safest asset on the planet.
And simultaneously, the U.S. government has to borrow trillions of dollars to project power and replenish its military stockpiles.
Precisely. To buy those replacements, the government issues debt. They sell bonds. When the government is borrowing trillions of dollars to build missiles, they're absorbing all the available capital in the financial system. That means the government is competing directly with you for credit.
Let me stop you, because I think a lot of people hear the government is borrowing and they think, well, that's Washington's problem, not mine. Walk us through the exact pipeline. How does the government replenishing missile stockpiles force a family's mortgage rate up?
It's a great question. Think of the global pool of money as a giant reservoir. When you go to a bank for a mortgage, the bank is dipping a bucket into that reservoir to lend you the money. But when the U.S. government needs $2 trillion to fund a defense budget, they back a massive industrial pump up to that same reservoir. Because the government is considered a risk-free borrower, investors would rather lend to the government than to you.
So the bank has to sweeten the deal.
Right. To convince investors to lend to a regular citizen for a 30-year mortgage instead of buying a risk-free government bond, the bank has to offer the investor a much higher interest rate. So the government borrows heavily, the supply of available credit shrinks, borrowing costs go up across the board, and the interest rate on your auto loan, your credit cards, and your mortgage gets more expensive.
It is a direct mathematical chain reaction. Let's bring it back home to the domestic side. Pass those potatoes again, and let me explain why your grocery bill feels like it is absolutely suffocating you right now.
We are currently sitting in the middle of what economists call a macro-stagflation trap. Stagflation is the ugliest word in finance. It means economic growth is stalling out, stagnating, while prices continue to rise, inflation. And right now, the entity that is supposed to fix this, the Federal Reserve, is completely paralyzed. Currently, the Fed is holding its benchmark interest rate flat at a target range of 3.50 to 3.75%.
And behind closed doors, the Federal Open Market Committee is deeply fractured. They don't know what to do. You have St. Louis Fed President Albert Musalem publicly stating that the current rate of 3.50 to 3.75% appropriately balances the risks. He looks at the data and thinks the risk of hurting the labor market and the risk of runaway inflation are equally balanced.
But then you look at Kansas City Fed President Jeffrey Schmidt.
Right. Schmidt is emphatically stating that fighting inflation must remain the primary singular challenge. He wants to keep rates restrictive. They are stuck in a strict wait-and-watch mode.
Paralyzed is truly the best word for it. But it's vital to understand that it's not just conflicting economic data they are fighting. They are currently embroiled in an unprecedented civil war within the federal government itself. The United States Justice Department has officially issued grand jury subpoenas targeting Federal Reserve Chair Jerome Powell.
Over a building renovation, right?
Exactly. The investigation is centered around a multi-billion-dollar renovation of the Fed's Washington headquarters. Right now, the Federal Reserve is fighting these subpoenas in sealed, closed-door court proceedings to protect what they view as their institutional independence.
Let's pause right here and do a strict impartiality check. I want to be crystal clear with you. At this table, we do not take sides. I don't care about the political objectives of the Trump administration, and I don't care about the political motivations of the Department of Justice. We do not deal in partisan politics. We deal in math. We just read the tape to protect your money. But you have to know the facts. President Trump has officially nominated former Fed official Kevin Warsh to replace Jerome Powell. The stated goal is to align the central bank more closely with the White House's economic vision.
And the financial world is reacting to this power struggle violently. JP Morgan CEO Jamie Dimon is out there publicly defending the independence of the Federal Reserve. Furthermore, 10 global central bank governors from around the world have issued an extraordinary, unprecedented joint statement offering their full solidarity to the U.S. Federal Reserve.
So why are we spending Sunday dinner talking about a DOJ subpoena and central bank politics? Why does this matter to your checking account?
Because of the chaos premium. Political risk premiums are being injected straight into the bond market. Let me explain it simply. The U.S. dollar is the global reserve currency because the world trusts the stability and independence of the U.S. Federal Reserve. When global bond traders, the people who lend trillions of dollars to our government, sit at their terminals and watch the U.S. government criminally investigate its own central bank, they get nervous.
They charge a premium for that nervousness.
Exactly. They charge a chaos premium. Institutional investors demand higher yields on U.S. debt when they feel institutional independence is threatened. And as we just discussed, when government bond yields go up, consumer borrowing costs go up. If you are sitting on the sidelines waiting for your mortgage rate to drop, you are essentially betting your family's financial future on domestic political stability. Ask yourself, does Washington look stable to you right now?
It certainly doesn't. Take a sip of that water because we need to pivot and talk about what I call the tariff illusion. The current administration has been heavily pushing temporary import surcharges, specifically relying on Section 122 tariffs. These measures have driven trade-weighted tariffs up to a massive average of 13.2%.
And the political narrative, the story you hear on the news, is that these tariffs are designed to protect American jobs and punish foreign manufacturers.
But a damning, highly detailed report from the New York Fed just proved the exact opposite. The data shows that 90% of the financial burden from these tariffs is directly hitting U.S. consumers. It's hitting you.
Let's break down the dinner table gambit on this because it gets even more complicated. The Supreme Court just handed down a massive ruling. They struck down a series of sweeping executive tariff measures known as the IEPA tariffs. IEPA stands for the International Emergency Economic Powers Act.
Wait, I thought the president had incredibly broad authority under IEPA to regulate commerce during a national emergency. Why did the Supreme Court step in?
They do have broad authority, but the court determined this specific application was an overreach. The majority, Chief Justice Roberts, along with Justices Gorsuch, Barrett, Sotomayor, Kagan, and Jackson, formed a coalition and struck the tariffs down. But here's the mechanical consequence you need to care about. Because those tariffs were deemed illegal, the federal government is suddenly facing a $200 billion black hole of retroactive refund liabilities. They have to pay that money back to the corporate importers who were illegally taxed.
And how does the government come up with $200 billion in cash overnight? They issue more debt. The Treasury has to flood the bond market with treasuries to finance those refunds. When you flood the market with supply, the price of the bonds drops, and the yield, the interest rate, is forced higher. Again, it's a mechanism that directly makes your life more expensive.
The economic data is already reflecting this strain. Deloitte is reporting that U.S. gross domestic product is decelerating, and they attribute it strictly to the impact of these tariffs. The financial firm RSM just released their 2026 economic outlook, and they are officially warning that we have entered stagflation light. They project a very modest 2.2% economic growth, but they forecast inflation being stuck permanently above the 3% mark.
The S&P Global Purchasing Managers Index, the PMI data, confirms this perfectly. The PMI showed that global economic expansion ticked up slightly to a 2.6% GDP equivalent. So there is some growth. But the report explicitly noted that this growth is deeply marred by intensifying output price inflation. Businesses are getting crushed by massive input costs, materials, energy, tariffs, and they are doing the only thing they can do to survive. They're passing those costs directly onto you, the consumer.
And you can feel the exhaustion in the consumer data. The Conference Board showed that U.S. consumer confidence inched up slightly in February, but when you look at the submetrics, future financial expectations remain highly, highly cautious. People feel it in their bones. You feel it at the grocery store.
Let's say you get a 3% raise at work this year. You feel great about it. But that 3% doesn't even come close to covering the hidden tariff tax on your basic appliances, your vehicle parts, and your food.
This is the textbook definition of a stagflationary squeeze. Prices are rising, wage growth is stalling, and the central bank is mathematically prohibited from cutting interest rates to give you relief. Because if the Fed cuts rates right now to help the consumer, they will inject more liquidity into the system, and inflation will explode even further. They are trapped.
Why don't you cut another slice of that pork shoulder? Take some more potatoes, too. You're going to need your strength for this next part, because everything we just talked about was macro-level theory. Now, we are going to talk about your W-2. We are going to talk about your actual livelihood, because it's under direct, unprecedented attack. We need to talk about the AI bubble and the massive historic shift happening in the global labor force.
If you turn on any financial news network, all you hear about is the stock market breaking records, driven entirely by artificial intelligence. So it looks like a new golden age. But there is a prominent economist named Service Storm from the Institute for New Economic Thinking, and he is sounding a massive blaring alarm.
Yeah, his report was a wake-up call.
He argues that the United States is dangerously betting its entire economic future on an AI data center bubble. And his critique is that this bubble completely lacks foundational economic intelligence. It is a highly speculative boom that is drawing hundreds of billions in capital away from sustainable, productive, real-world investments.
And the really smart money, the institutional capital, is already seeing the writing on the wall and leaving. We are currently witnessing a historic seismic shift in global capital flows. Over the past 6 months, investors have pulled roughly $75 billion out of U.S. domiciled equity products. Let me repeat that. $75 billion has fled the U.S. stock market. That is the fastest pace of domestic capital outflows we have seen in 16 years. The decade of absolute American market dominance is fracturing right in front of us.
So where is all that money going? If it's leaving the U.S., where does it find a home? Emerging markets. Fidelity Investments put out a fascinating note. They pointed out that if you look past the deafening hype of the American tech sector, traditional non-tech global industry actually outperformed the services sector last year. Real companies making real things are winning.
Look at the Asian markets. The MSCI Asia-Pacific Index just climbed 6.7%, which marks its strongest February performance since 1998. South Korea's Kospi Index surged roughly 20% in a single month. Why? Because global investors are viewing these Asian manufacturing firms as the picks and shovels of the global AI revolution.
Let's stop and unpack that picks and shovels analogy because it's crucial to understanding how wealth is actually built during a bubble.
Yeah.
During the California gold rush, the vast majority of prospectors that went panning for gold went completely broke. The people who made the guaranteed massive fortunes were the merchants selling the pickaxes, the shovels, and the denim jeans.
Exactly. Right now, the U.S. tech companies are the prospectors, desperately panning for an AI breakthrough. But the Asian manufacturing sector, the companies building the physical semiconductor chips, the cooling systems for the data centers, the raw hardware, they are the ones selling the shovels.
And South Korea recognizes this incredible advantage. Their Ministry of Finance is so confident in their position that they're issuing 19,000 billion won in treasury bonds this March, just to fund sovereign initiatives and expand their industrial base. Capital is actively fleeing the speculative U.S. tech bubble and rushing toward tangible, physical, global manufacturing.
Now let's talk about why that U.S. tech bubble is so dangerous to you personally. We are entering what the industry is calling the SaaS-pocalypse. Software as a service is collapsing. Recently, we saw $2 trillion in tech market capitalization evaporate into thin air. $2 trillion. Why did that happen? It happened because of the release of a new AI model called Anthropic's Claude Opus 4.6 and a new trend called vibe coding.
Vibe coding. It sounds like a joke, but it is destroying entire corporate structures. Let me explain what it is. Imagine you spent 4 years getting a computer science degree, and you make $150,000 a year writing back-end code for a payroll processing company. Suddenly, a basic user with no formal coding background goes onto GitHub, downloads a single folder of open-source AI prompts, and feeds them into Claude Opus 4.6.
And the AI just does it.
Through simple natural language instructions, just describing the vibe or the goal of the program, that AI autonomously executes complex workflows. It writes the code, debugs it, and deploys it. That user just completely bypassed the legacy developer. They automated a 6-figure salary for the cost of a $20 monthly subscription.
And the corporate bloodbath is staggering. When this technology hit the market, the stock of IBM dropped 13% in a single day. LegalZoom plummeted 20%. RELX, a massive analytics company, fell 14%. The fintech company Block abruptly cut 40% of its entire workforce. eBay slashed 800 domestic roles and announced they are offshoring whatever development work remains to India and Ireland. But here is the terrifying part. Even the offshore havens aren't safe. The Indian IT services sector fell 21% in a month.
It even hit the cybersecurity sector, which everyone assumed was bulletproof. AI agents were deployed to scan open-source projects, and within hours, they identified 500 hidden security flaws that human engineers had missed for years. It instantly commoditized the entire cybersecurity market, crashing the stock prices of industry darlings like CrowdStrike, Datadog, and JFrog.
I really need you to let that sink in. The traditional career moats are gone. A college degree and a white-collar skill set used to guarantee a lifetime of financial security. Not anymore, and it is creating a terrifying new metric in the financial world. Superprime mortgage delinquencies just spiked 26.2% year over year.
For context, A superprime borrower is someone with an 800 credit score. These are people who historically never default. They have massive tech salaries, huge portfolios of restricted stock units, and significant cash reserves. But they are defaulting in droves right now. Why? Because their entire industry vanished overnight due to AI displacement. Their stock options became worthless, their six-figure salary disappeared, and they suddenly couldn't afford their $7,000 monthly mortgage payment.
The technical term for this is OpEx substitution, operating expense substitution. Corporations are aggressively firing human beings, which are operating expenses, to free up cash so they can fund $1 trillion in AI server infrastructure. They are trading human capital for silicon.
And it's causing a massive inversion in the labor market. Historically, blue-collar manufacturing was considered vulnerable to automation, while white-collar office work was safe. We are seeing a complete blue-collar versus white-collar flip. Now, to be fair, blue-collar work isn't totally immune. The Reuters Trumponomics report recently showed that U.S. manufacturing jobs are declining despite all the heavy tariffs designed to protect them, which proves that factory floors are heavily automating as well.
But the real devastation is hitting the youth and the entry-level white-collar market. Over in the UK, the Office for Budget Responsibility just issued a forecast predicting a terrifying 16% youth unemployment rate. Businesses across the globe are completely freezing their entry-level recruitment to shield their profit margins. They don't need junior analysts or junior copywriters anymore. And AI can do that work instantly for pennies.
The government is fully aware this is coming. That's why the Departments of Education and Labor officially designated February 2026 as National Career and Technical Education Month. They are heavily, aggressively pushing short-term, competency-based education and physical apprenticeships, plumbing, electrical work, specialized mechanical repair over traditional four-year liberal arts degrees. They know the algorithm can't fix an HVAC system.
And even the foundational bedrock of the American economy, agriculture, is fracturing under these massive shifts. The text for the 2026 Farm Bill was just released. One of the most telling details is that they had to double the microloan caps for farmers from $50,000 to $100,000. Why? Because the baseline cost of farming operations, fertilizer, diesel equipment is absolutely surging.
A new agricultural report shows that a structural supply and demand imbalance, combined with these operating costs, is forcing 7% of American corn farmers into early retirement. They are just walking away. The middle of the economy, both the rural agricultural base and the suburban white-collar professional class, is hollowing out simultaneously.
So what is the implication for you? Sitting right here, how do you protect yourself? Look at the behavior of the crypto markets. Binance is reporting a massive surge of investors actively fleeing volatile equity markets and dumping their cash into high-yield fixed deposits that pay just over 3%. These are aggressive risk takers who are suddenly prioritizing capital preservation and stability above all else. You must secure your career and your physical assets right now.
Here is the ground truth. If you are sitting on a solid W-2 salary right now, you need to understand that loan origination costs in the mortgage industry have surged 35%. Why? Because lenders are replacing human underwriters with large language AI models. These autonomous underwriting agents are entirely unforgiving. They don't listen to nuance, they don't care about your story, they look strictly at the data.
And if your income structure changes, if you get laid off from your W-2 job and you are forced to become a 1099 contractor or you enter the gig economy to survive, you will be pushed completely out of the prime mortgage market. You will be forced into what we call the non-QM space.
Non-QM stands for non-qualified mortgage. In plain English, it's a lending market designed for people who don't fit into the neat, traditional W-2 employee box. And because the algorithm sees a 1099 contractor as a drastically higher risk without that guaranteed steady corporate paycheck, the lenders penalize you. Interest rates in the non-QM space right now are a punishing 7.50 to 8.50%.
That is the danger. You must lock in prime agency debt today while your W-2 is still intact before the algorithms render your specific job obsolete and reclassify you as a high-risk borrower.
Let me pour some water for everyone. We've covered the global wars, the stagflation trap, and the AI labor crisis. Now, we need to talk about the roof over your head. This is what I call the macro-micro window. Amidst all this chaos, this is the one area where you actually have personal leverage to protect yourself from everything we just discussed.
Right now, we are seeing a mirage in the housing market. It looks like an oasis, but you have to understand the mechanics behind it. Recently, the average rate on the 30-year fixed mortgage dipped below 6% for the first time in 3.5 years. Freddie Mac reported it hit 5.98%. If you look at the 15-year fixed, it's sitting at 5.37%, and the 30-year fixed APR is hovering around 5.87%.
And the real estate industry is jumping on this data to push a massive buy now narrative. Zillow put out an analysis showing that a median income household can now afford a $331,483 home. They're advertising that as a $30,000 improvement in purchasing power compared to last year. It sounds like the clouds are parting.
But listen to me carefully. This is a fleeting, temporary window. It is being driven entirely by temporary bond market panic. What happened was institutional investors got spooked by some weak economic data, and they rushed into bonds, which caused the 10-year Treasury yield to drop to 4.02%. Some of the futures markets started blindly pricing in aggressive rate cuts from the Fed.
But remember what we talked about earlier. Lenders are terrified. They're looking at the SOS-pocalypse. They're seeing 800 credit score super prime borrowers default, and they are terrified of risk. So, even though bond yields dropped, lenders are keeping retail mortgage rates artificially sticky. They are padding their profit margins to absorb future defaults.
We have to completely tear down the myth right here at this table that mortgage rates are ever returning to 3%. It is a psychological trap that is keeping people paralyzed.
Absolutely. CBS News and essentially every credible financial expert have explicitly warned that the pandemic-era mortgage rates of 2.5 to 3.5% were a massive historical anomaly. They were the result of emergency, once-in-a-century Federal Reserve interventions. The market equilibrium has structurally shifted. Expecting a return to sub-4% rates is historically illiterate. We are advising every single one of our clients to sit down and mathematically calculate their break-even point today.
The Hindustan Times had a great piece noting that homeowners who bought their homes when rates peaked above 7% are currently refinancing in absolute droves. They understand the math. If you can drop your interest rate by just 0.75% today, you can typically offset the closing costs of the refinance within 36 months. And for many people, because property values have remained artificially high, refinancing allows them to recalculate their loan-to-value ratio and eliminate costly private mortgage insurance entirely.
You don't sit around waiting for a fantasy 3% rate that is never coming back. You secure the tangible, concrete savings sitting right in front of you today to stop the cash flow bleed in your monthly budget.
Now, a logical question you might have is, if borrowing money is still historically expensive compared to 3 years ago, why haven't home prices crashed? Why is housing still so expensive? It is because of artificial floors and massive structural government interference. Right now, nearly 69% of all U.S. homeowners are rate locked under a 5% mortgage. Think about that. Nearly 70% of the country has a mortgage rate they will never willingly give up.
They are financially handcuffed to their current homes. They cannot afford to sell and buy a new house at 6.5%. That completely constricts the inventory of available homes, which artificially props up the prices.
And you aren't seeing the massive wave of distressed sales that usually accompany a tough economy. Safeguard Properties reported that zombie foreclosures, which are abandoned properties left to rot in the foreclosure pipeline, are incredibly low, making up just 3.27% of homes currently in the foreclosure process. Now, overall foreclosure filings did rise 32% year over year, according to ATTOM data, but we have to put that in context. They are still well below the normal pre-pandemic baselines. People are clinging to their home equity like a life raft.
And whenever prices start to soften, the government is actively stepping in to keep them propped up. Look at California. The California Housing Finance Agency is resuming what they call the Dream for All Shared Equity Program. In this program, the state government literally acts as an equity partner, providing down payment assistance to subsidize entry-level demand. When the government hands out cash to buyers, prices go up, period.
Meanwhile, at the federal level, the administration issued an executive order targeting institutional single-family rental acquisitions. They are trying to pass regulations to stop Wall Street private equity firms from buying up entire neighborhoods and turning us into a renter nation.
Because the rental market itself is a complete disaster right now. The safety net is failing. The Richmond Redevelopment and Housing Authority just announced a mandatory massive purge of its waitlist. They are requiring 20,000 desperate applicants to digitally update their status within a strict window, or they entirely lose their spot for affordable housing.
And out in Los Angeles, you see the catastrophic results of overregulation. The city implemented strict rent stabilization ordinances, legally capping annual rent hikes at just 4%. Now, that sounds great for the renter in the short term, but what was the macro result? Developers looked at the math, realized they couldn't turn a profit with a 4% revenue cap while their costs were soaring, and they completely walked away. New multifamily construction in Los Angeles plummeted by an astonishing 70%.
By trying to protect renters, they guaranteed a massive future housing shortage, which will inevitably lead to explosive rental growth down the line. Overall, real estate forecasts for 2026 predict slower, calmer price growth of about 2 to 3.6% nationally. It is a stabilization, not the crash that everyone was hoping for.
But you cannot just look at the purchase price and the mortgage rate. You have to factor in the hidden holding costs. Owning a physical home is more than just making the monthly principal and interest payment. Cotality, a leading real estate analytics firm, projects that homeowners insurance premiums are going to spike by an average of 16% over the next 2 years alone. Bankrate just confirmed that the national average for home insurance has already hit $2,424 annually.
Why is insurance exploding? Two reasons. First, the increasing frequency of extreme weather events is causing massive payout losses for insurers. Second, it goes right back to the tariffs we discussed an hour ago. When the government places a 13% tariff on imported building materials, lumber, steel, copper, it artificially inflates the cost to rebuild a house. When the replacement cost of your home surges, your insurance company automatically triggers an increase in your required coverage limits, which spikes your premium.
And there is a massive, incredibly complex shadow banking risk lurking behind the entire housing market. It is something analysts are calling the Bermuda Triangle contagion. Let me try to explain this as simply as possible. Imagine you co-sign an auto loan for a friend, but to protect yourself, you buy a specialized insurance policy just in case they total the car. Now imagine the insurance company goes bankrupt because they secretly took your premium money and gambled it on bad tech stocks.
Suddenly, you are entirely on the hook for the risk.
Exactly. That is exactly what is happening behind the scenes with the American mortgage market.
Let me walk through the exact pipeline of how that works because it's terrifying. Over the past few years, massive private equity firms have taken control of $1.1 trillion in life insurance premium reserves. They took that money and moved it into offshore shell companies, heavily concentrated in places like Bermuda. These offshore shell companies then took that $1.1 trillion and invested it heavily into high-yield, risky software and tech debt, the exact same tech sector that is currently collapsing due to the SaaS apocalypse.
Here is where the trap closes. Those exact same offshore shell companies in Bermuda are the entities providing the reinsurance policies that back up Fannie Mae and Freddie Mac's credit risk transfer programs. If those risky tech loans default, it impairs the offshore reinsurers. If the reinsurers go bankrupt, Fannie Mae suddenly has no backstop. If Fannie Mae loses its safety net, they will instantly, overnight, hike their guarantee fees on every single new mortgage originated in the United States to cover their systemic risk. Your mortgage costs will skyrocket not because of your credit score, but because a shell company in Bermuda gambled on a failed AI startup.
Furthermore, we have the Global Fraud Summit currently convening in Vienna to tackle an explosive rise in transnational crime. As cyber fraud and digital theft become a daily global reality, hard physical assets like American real estate are becoming the ultimate safe haven. Global capital wants to hide in American dirt. They don't trust digital ledgers. They want physical property.
Let's clear these plates. The dinner is winding down. I've got a pot of fresh espresso brewing, and I'm going to put out a plate of these cannolis. We've given you a massive, heavy amount of information to chew on tonight, and I know it can feel overwhelming.
Take your espresso. Drink this, it settles the stomach. Let's briefly recap the grand scheme so you can organize all of this in your head. We started with the Horizon scan. The Middle East is a literal powder keg. The weaponization of the Strait of Hormuz is guaranteeing severe energy inflation, and global logistics are fracturing under war and tariffs.
Then we looked at the domestic macroeconomy. The Federal Reserve is completely paralyzed, caught in a stagflationary trap while its own chairman fights criminal subpoenas, injecting a chaos premium into your borrowing costs.
We exposed the truth of the AI bubble. White-collar W-2 jobs are evaporating, enterprise software multiples are collapsing, and institutional capital is fleeing the United States for tangible Asian manufacturing.
And finally, we gave you the ground truth on housing. The sub-6% mortgage rate is a fleeting mirage, property values are propped up by artificial supply floors, and the cost of simply holding an asset is surging due to insurance spikes and shadow banking risks.
We promised you the ground truth to protect your solvency, and here it is. The absolute bottom line is that you cannot wait out this market. You cannot hunker down and rely on a paralyzed central bank to swoop in and save you. You must take control. You must become the chief financial officer of your own household right now. If you own a home, you extract equity to build a cash reserve. You consolidate your variable high-interest consumer debt immediately. And you lock yourself into the safest, highly regulated fixed-rate vehicle available while human underwriters will still look at your W-2 and approve your file.
Before we wrap up the Sunday dinner, I want to leave you with one final, totally unscripted thought to mull over. Take a bite of that cannoli and just think about this concept for a minute. If sovereign governments across the entire globe are maxing out their national debt to fund kinetic wars and bail out failing corporations, and if global trust in institutions is completely collapsing from international criminal court sanctions to transnational cyber fraud, is holding a fixed-rate, 30-year mortgage on a physical piece of land actually the ultimate short position against a failing fiat currency system?
That is an incredible question to ponder. Because as inflation inherently eats away the purchasing power of the US dollar, it mathematically eats your fixed debt too. You're borrowing highly expensive, valuable dollars today to buy a hard asset, and you have to pay the bank back with cheaper, continually degraded dollars for the next 3 decades. It is arguably the most powerful financial shield legally available to the American middle class today.
Finish your cannoli. Drink your espresso. Digest all of this information tonight. Let it settle. Get your mind right and look at the world clearly. Because the next time we sit down at this table, we aren't just going to look at the board and analyze the pieces. We are going to discuss exactly how to execute your specific survival strategy step by step.
Beat up. We'll see you work tomorrow.
Come on in. Sit down. Take off your coat.
Good to see you. Pull up a chair right there.
Yeah, sit right there. Eat. Grab that serving spoon right next to the bread and take some of this slow-roasted pork shoulder before it falls apart completely.
It smells incredible.
Get a generous helping of that baked ziti on your plate, too. Let the Sunday gravy settle, and let me pour you a glass of this Barolo. There you go.
Perfect.
I want you to just sit back in that chair for a second, take a breath and take a sip. You look completely exhausted.
You really do. I mean, pass that garlic bread over here, would you? Thanks. But really, we know you've been burning the candle at both ends lately.
Exactly. I saw the stack of printouts and articles you dropped on the kitchen counter when you walked in. I was looking through them earlier.
Quite the reading list.
It really is. You've got Zillow housing reports in there, Deloitte macroeconomic white papers, New York Fed data, Kita logistics analyses, and, even the latest Supreme Court filings.
Heavy stuff for a Sunday.
Right. You are clearly putting in the hours, studying the markets, trying to figure out your next financial move for your household. But look, I am going to shoot you straight right out of the gate tonight. You aren't stepping into a normal economic cycle. You're stepping into a meat grinder.
A total meat grinder.
The mainstream media is feeding you a completely false narrative about this so-called economic recovery. They want you to think everything is normalizing. But we have been sitting at tables exactly like this, doing this job as loan officers, navigating these capital markets for 3 decades.
30 years.
We survived the dot-com bust, we survived the 2008 housing collapse, and we survived the pandemic madness. And what we are looking at right now, looking at the very data you brought over, is a systemic unwinding.
It is a systemic unwinding. And listen, our goal tonight, the entire mission of this deep dive into the raw, unfiltered data you brought us, is to understand the grand scheme of what is actually happening out there in the machinery of the economy.
The actual gears turning.
Right. We need to establish the ground truth. We are here to protect your household solvency, plain and simple. And I want to be incredibly clear before we even start. We do not care about the partisan theater in Washington.
Not at all.
The red versus blue circus on the news is just noise meant to sell advertisements. We are looking strictly at the math. What we care about is how sovereign debt, technological displacement, and global conflicts act as macroeconomic catalysts that directly, and I mean mathematically, impact your bond yields and your risk premiums.
That's the only thing that matters to your wallet.
Exactly. So tonight, we are going to walk you through a strategic briefing based on your research. We're going to look at the exact matrix of what is mechanically happening out there piece by piece so you can make the right moves to protect your family's balance sheet.
So let's unpack this. I want to start by dismantling this dangerous, lingering hope you might have that rates will drop if you just wait. I hear it every single day. But let's look at the first paper in your stack regarding the Supreme Court invalidating the IEEPA tariffs.
Yes. The IEEPA ruling.
No. IEEPA stands for the International Emergency Economic Powers Act. The headline makes it sound like a simple legal or political dispute, but let's break down what that actually means mechanically for the banks and ultimately for you.
Right, because this is a massive fiscal shock. The government have been relying on those tariff revenues. With the Supreme Court striking them down, the Treasury is suddenly facing a massive hole in its budget. We are talking about a government deficit forced open by somewhere between $1.5 trillion and $2.4 trillion.
It's an astronomical number.
It is. Now, how does the government pay its bills when it suddenly loses $2 trillion in expected revenue? They don't just cut spending overnight. They issue bonds. They borrow the money.
Exactly, and this is where it hits you directly. The bond market suddenly has to absorb this massive, unexpected flood of U.S. Treasury debt. If you are the government and you suddenly need to sell $2 trillion worth of bonds, you have to attract buyers. To attract buyers, you have to offer a higher return.
Yields have to go up.
Yields have to go up. And when bond yields go up, the cost of all consumer debt goes up. If you sit on your hands and wait for a better day, the interest rates on your credit cards, your auto loans, your variable rate ECLOCs are going to surge alongside those bond yields.
They absolutely will.
Refinancing your variable debt right now migrates that exposed risk into a fixed 30-year shelter before the government's borrowing spree crowds you out of the market entirely.
And that ties directly into what I call the wait-and-see wealth drain. Look at the recent mortgage rate sheets. We recently saw rates dip to 5.98%. That is a rare sub-6% window.
Very rare right now.
But I know what you're thinking. You remember 2020-21, you're thinking, I'll just wait for a return to 3%? But expecting a return to 3% is historically illiterate.
It really is.
Those pandemic-era rates were a once-in-a-lifetime anomaly driven by emergency Federal Reserve interventions that simply do not exist anymore. If you fail to lock in today's sub-6% rate because you are chasing a ghost from 2021, you are bleeding household cash every single day via compounding high-interest consumer debt. The math simply does not support waiting.
Let me ask you this. Just think about this while you eat. Everyone thinks the government tariffs, when they were in place, were making us money as a country, right? That's the illusion. But the Supreme Court actually struck down those tariffs. And because of how the law works, it leaves the government owing $200 billion in corporate refunds right now.
Immediately.
The Treasury is basically maxing out the national credit card to pay back corporations. So are you really holding out for a lower mortgage rate while the Treasury is actively, forcefully pushing borrowing costs higher to cover their legal losses? If you wait, you are the one losing money.
It's the ultimate trap. And while you're waiting, the burden of everyday living is shifting directly onto your shoulders. Look at the New York Fed report you printed out. They just confirmed that 90% of the costs of the remaining trade tariffs are hitting consumers directly.
90%.
Let that sink in. That foreign exporters aren't absorbing the cost. You are paying it at the grocery store, the hardware store, the gas station. Migrating your variable high-interest debt into a fixed mortgage is the only mathematical defense you have to offset the permanent increase in the cost of basic household goods. You have to fix your housing cost because your living costs are running away from you.
Because the reality of the economy right now, despite what the morning shows say, is stagflation. The Deloitte and RSM white papers in your stack outline a severe GDP deceleration. They are warning of a persistent stagflation-light environment.
Let's define that for a second. Stagflation is the ugliest word in economics. It means economic growth is slowing down, stagnating, but prices are staying high, which is inflation. Normally, if the economy slows down, prices drop. Not right now.
And crucially, wage growth is stalling out.
Exactly. If you take no action, if you just float along with your current debt structure, you are leaving your family's cash flow fully exposed to rising consumer costs without any matching wage growth to bail you out. You are getting squeezed from both sides.
Here is where it gets really interesting and honestly a little terrifying. Pass the Parmesan cheese for a second, thanks. We need to talk about the yield curve contagion. The financial media has been buzzing because the yield curve just uninverted to a positive 59 basis points.
Stop right there. Let's make sure we really understand what uninversion means, because the media completely misrepresents this. They say, oh, it's uninverting, the curve is returning to normal, the economy is healing. No, an inverted yield curve is just the warning track. The uninversion is the actual crash.
Right, let's break that down for you in plain English. Normally, if you loan your money out for 10 years, you expect a higher interest rate than if you loan it out for 2 years, because there is more risk over time. That is a normal, upward-sloping yield curve.
Makes perfect sense.
An inverted curve is when the 2-year bond pays more than the 10-year bond, which is totally backwards. It happens when the market is panicking about the short-term future.
And banks hate an inverted curve. Think about how a bank makes money. They borrow short-term money from depositors, your checking and savings accounts, and they lend it out long-term, like a 30-year mortgage. If short-term rates are higher than long-term rates, the bank's profit margin gets crushed. They actually lose money by lending, so they stop wanting to lend.
So when the curve uninverts, when the short-term rates rapidly drop back below the long-term rates to create a normal slope again, it's usually because the Federal Reserve is panic-cutting short-term rates because something in the broader economy just broke.
The historical data on this is flawless.
It really is. Once the curve hits positive 59 basis points like it just did, the clock starts. Historically, you have exactly 18.5 weeks until an official deep recession hits. It is a ticking clock.
Exactly 18.5 weeks. And in that window, credit markets freeze. Banks get terrified. They tighten their lending standards to survive the incoming contraction. If you wait to refinance your house until after the recession hits, hoping for a better rate, you're going to find that the bank vault is completely locked.
They won't take your calls.
Refinancing today secures your liquidity before the credit markets totally freeze up.
And look at the 10-year Treasury fakeout you highlighted in your notes. You probably saw the 10-year Treasury yield drop below 4% recently due to some global panic, and you figured mortgage rates would plummet right alongside it. But they didn't, did they?
Not at all.
Lenders kept 30-year mortgage rates sticky at around 5.87%. Why? To pad their margins against the rising default risks they see coming from that yield curve uninversion. The banks are swallowing the discount. If you wait, you're just letting the house keep the spread. Why aren't we locking in now before they widen that gap even more out of fear?
We also cannot ignore the geopolitical risk premium. We saw the recent U.S.-Israeli kinetic strike on Iran. Now, regardless of the politics of the region, we have to look at the macroeconomic result. That strike has fundamentally altered the global energy landscape. The resulting aggressive posturing and blockades in the Strait of Hormuz practically guarantees sustained energy inflation. Analysts are projecting oil to hit between $90 and $130 a barrel and stay there.
Try filling your gas tank or paying your heating bill with $130 oil. It drains your discretionary income instantly. A fixed-rate mortgage right now acts as an absolute, tangible hedge against that impending oil shock. You lock in your primary living expense, your shelter, before energy costs drag the rest of your monthly budget to zero.
Now, you might be wondering why your house hasn't lost value yet despite all this pressure. There is an artificial supply floor propping up your property value right now. The Section 122 tariffs specifically target imported construction materials like steel and lumber.
It is incredibly expensive to build right now.
It is incredibly expensive for developers to build a new house. That lack of new construction acts as an artificial floor under current home prices.
Yeah.
By consolidating your debt now, you are leveraging that artificially protected home equity before broader economic turbulence starts impacting global appraisals.
But you have to act fast because the institutional players, the smart money, they are starting to exit the housing market. There's a new executive order moving through the pipeline targeting institutional single-family buyers. Wall Street firms are going to be heavily restricted from buying up entire neighborhoods to use as rental farms.
It's a huge shift.
When that happens, it removes a massive pillar of demand from the housing market. Extracting your equity now via cash-out refinance allows you to capitalize on peak institutional valuations before those massive corporate portfolios fully unwind and flood your local market with inventory, driving your appraisal down.
And the capital isn't just leaving the domestic housing market, it is actively leaving the country. We are seeing massive global capital flight. Capital is actively slowing out of U.S. equities and into emerging markets, specifically in Asia, where growth prospects look better relative to our stagflation.
The money always goes where it's treated best.
Always. When foreign investors pull their money out of the U.S., domestic borrowing costs face intense upward pressure. The Treasury has to offer higher yields to attract that capital back.
Right.
The cost of inaction on your part is missing this current temporary window where Treasury yields are being slightly suppressed by domestic panic.
Have some more of that pork. It's getting cold. I know this is a lot to digest. Look at the Zillow data. They are showing that purchasing power has hit a recent peak, with affordability briefly improving as rates hover near 6%.
But that affordability window is fleeting.
Debt migration today locks in this temporary affordability before the structural sovereign deficit permanently raises the baseline cost of capital across the board.
Think about what the smartest money on earth is doing right now. Central banks around the world are buying up physical gold at a historic pace. They are targeting $5,400 an ounce. Why? Because they are hedging against the U.S. dollar, losing its purchasing power due to massive deficit spending.
Exactly.
If your personal debt isn't locked into a fixed, tangible asset like a 30-year mortgage on a piece of property, you are absorbing that dollar inflation directly. A fixed mortgage is the average person's version of a gold hedge. You are borrowing dollars today and paying the bank back over 30 years with dollars that are worth less and less. If you don't use a fixed mortgage, you're essentially subsidizing the government's inflation.
And finally, for this part of the data, beware the ghost GDP mirage. The news says GDP is growing. It looks decent on paper, but it's an illusion. Artificial intelligence is generating massive output and efficiencies for major corporations, padding the national statistics.
But AI agents don't buy houses.
Right. They don't buy groceries, they don't go to restaurants. The actual money velocity, the rate at which everyday consumers are spending money locally, is collapsing. The economy is growing, but you aren't invited to the party. Consolidating your debt into your home is the only way to build a personal firewall against a macroeconomy that no longer needs human consumers to generate output.
Which is a perfect transition into the next phase of our briefing, looking at the tech sector data you brought. Let's talk about the SaaS apocalypse and the W-2 income fracture.
Let me pour a little more wine for this one, because this is where the ground really shifts under your feet. We need to completely shatter the illusion of white-collar job security. You've always thought having a tech job or a middle management corporate job meant you were safe. But there's an absolute urgency to secure prime debt right now before AI changes the underwriting rules completely.
We are witnessing an intelligence displacement spiral. With the release of advanced models like Claude Opus 4.6, legacy software as a service, what we call SaaS, is being completely commoditized. If you have W-2 income in tech, coding, or middle management, you need to secure a home loan right now while your W-2 is still recognizable to conventional automated underwriting systems.
Because that traditional 9-to-5 corporate income structure is evaporating.
Rapidly evaporating.
Let's make this tangible. Imagine a mid-level software engineer. Let's call him Dave. Dave makes $150,000 a year writing API documentation and basic code. He's got a W-2, he's got great credit. A bank looks at Dave and says, perfect borrower.
Standard A-paper loan.
Right. But overnight, his company realizes an LLM can write that documentation in seconds for pennies. Dave loses his W-2 job. He scrambles and eventually finds freelance work as a contractor doing prompt engineering or project management. He's still making decent money, but now he is a 1099 independent contractor.
And that is where the trap snaps shut. If Dave waits until his job structure changes to apply for a refinance, he is going to face the non-QM penalty.
Exactly. Let's explain QM versus non-QM. QM stands for Qualified Mortgage. That's your standard Fannie Mae or Freddie Mac loan. It requires standard W-2s and pay stubs, and it gives you the best interest rates. When you lose that W-2 and become a freelancer, you no longer qualify for a QM loan.
You're pushed into a different risk pool.
The mortgage industry is pivoting heavily toward non-QM, non-qualified mortgage loans to service displaced workers like Dave. These are often bank statement loans where the lender has to analyze 12 to 24 months of your business bank deposits to guess your true income.
But those non-QM loans carry massive risk for the lender, so displaced workers face punishing interest rates of 7.50 to 8.50%. Waiting to refinance while you still have your W-2 equates to volunteering for a massive 2% contractor penalty on your interest rate once your W-2 inevitably vanishes.
And we are already seeing the superprime crack. The data shows a 26.2% spike in superprime early-stage mortgage delinquencies.
Let's clarify superprime. We always assume foreclosures only happen to people who make bad financial decisions or have terrible credit.
Yeah.
But superprime refers to borrowers with 800-plus credit scores. These are traditionally the safest borrowers on paper.
The cream of the crop.
And they are defaulting at a staggering rate right now because their highly paid tech jobs disappeared overnight and they had no liquidity. Lenders are seeing this data just like we are, and they're going to aggressively tighten their prime credit overlays. You need to migrate your debt now while your pristine credit score still guarantees you top-tier pricing before the banks start penalizing everyone in the tech sector just by association.
The disruption is systemic. Look at vibe coding. IBM stock dropped 13% in a single day recently, simply over fears that conversational AI coding Vibe coding, where you just talk to the computer and it builds the software, will render their massive legacy consulting services obsolete.
It proves that absolutely no corporate role is safe.
A cash-out refinance right now creates a vital liquidity runway. It gives you a cash buffer in your bank account to protect your family during the inevitable transition from a stable W-2 to the unpredictable gig economy.
Even the cybersecurity moats are evaporating. We used to think, well, AI can write code, but we will always need humans for cybersecurity. Not true. AI agents recently found 500 hidden flaws in major open source projects, which completely crashed the valuations of major cybersecurity firms like CrowdStrike and JFrog.
Incredible.
If you work in a highly compensated tech sector, your restricted stock units, your RSUs, and your base salary are at peak vulnerability. You must lock your 30-year mortgage before underwriters start aggressively discounting your tech sector income because they view your industry as high risk.
The layoffs are accelerating rapidly. Block just cut 40% of its staff. eBay slashed 800 roles. This isn't some futuristic prediction for 2030. The displacement is happening today. Facing these brutal job market realities with high-interest, variable credit card debt draining your monthly reserves is financial suicide. You are walking a tightrope with no net.
And why are these companies firing people? It's not because they are losing money. It's OpEx substitution. OpEx is operating expenses, meaning human salaries. Corporations are mathematically compelled to slash human capital expenditures and redirect those funds into CapEx, capital expenditures, to build out $1 trillion in AI infrastructure.
It's the ultimate betrayal. People assume that because corporate profits are at all-time highs, the wealth will eventually trickle down to the employees. But companies are taking those record profits and explicitly replacing human staff with NVIDIA server racks.
Your company is actively planning your obsolescence.
If you don't extract your home equity to consolidate your debt now, you are going to face that layoff with maxed out credit cards. Consolidating your consumer debt into a fixed mortgage protects your monthly cash flow from this permanent structural compression of middle-class wages.
And here is the kicker. The banks are doing the exact same thing to their own employees. Automated underwriting strictness is going through the roof. Loan origination costs have surged 35% since 2020 because compliance is so expensive. To save margins, lenders are replacing human loan processors with large language models.
Think about what that means for you. You might think, oh, I have a great relationship with my local banker, Jim, down at the branch. He knows me, he knows my business, he'll always approve my loan. But unforgiving AI models are replacing Jim.
Jim is gone.
A human underwriter can look at your tax returns, understand a dip in income because you took time off for a medical issue, and see the context. An algorithm just sees a negative risk factor, compares it to a million other data points, and declines the file in milliseconds to maintain origination speed.
These algorithmic underwriters execute rigid, binary credit decisions. They will ruthlessly reject marginal or complex debt-to-income profiles. You need to secure your loan today, leveraging existing human underwriting flexibility before hyper-strict algorithms completely dominate the landscape. Are you really going to risk your home's financing on whether a chatbot likes your credit profile next year?
We have to look at global leading indicators, too. The youth employment warning out of the UK is staggering. They are reporting 16% youth unemployment. Businesses are freezing entry-level hiring entirely to fund AI integration.
Why hire a junior analyst out of college when an AI can do the grunt work for free?
This is a leading global indicator. Extracting your home equity now guarantees you have the capital required to support your children's independence through this massive structural labor fracture as they struggle to enter the workforce.
Let me put it to you like this across the table. Open source AI just wiped $2 trillion off the market value of legacy tech firms. If the code that runs the world can write itself overnight, how safe is your W-2? If you don't lock your mortgage while you still have those recognizable pay stubs, you are playing Russian roulette with your housing stability.
Let's shift gears and look at the third section of data you brought, focusing on geopolitical risk and the insurance contagion. We need to expose the hidden macro threats that could completely freeze mortgage liquidity in the U.S. and make your property fundamentally uninsurable.
Have a little more wine, because this section is heavy, but it is critical. Let's start with the Hormuz inflation anchor. The Islamic Revolutionary Guard Corps, the IRGC, is actively engaging in blockades and harassment in the Strait of Hormuz.
Let's explain why a strait halfway across the world matters to your mortgage in America. The Strait of Hormuz is a 2-mile choke point where roughly 20% of the daily global oil supply passes through. If ships cannot safely pass, global oil prices skyrocket. That energy inflation bleeds into the cost of everything, transporting food, manufacturing goods, heating homes.
And when inflation spikes, it permanently binds the Federal Reserve. The Fed's primary job is to control inflation. They cannot legally or ethically cut interest rates when energy inflation is roaring. That makes today's mortgage rates the absolute floor. If you're waiting for a rate drop, you're essentially betting that there will be sudden, lasting peace in the Middle East. Are you really betting your family's budget on stability in a multi-generational war zone?
And while you're looking at the Middle East, don't miss the threat lurking right offshore in our own hemisphere. Let's talk about the Bermuda Triangle contagion. This is complex, but it is the key to the whole system.
Over the last decade, private equity firms have pushed $1.1 trillion of life insurer reserves into offshore shell companies in places like Bermuda to avoid strict U.S. capital requirements.
All right, let's connect the dots for you. What does a life insurance company in Bermuda have to do with your house? It's shadow banking. Life insurance companies collect premiums for decades before they have to pay out a death benefit. They have to invest that cash somewhere safe to earn a return. Historically, they buy mortgage-backed securities. They are the ones buying your mortgage from the bank.
Exactly. But recently, those private equity firms managing the insurer's money chased higher yields by investing heavily in the risky tech and software debt we just talked about. Those reserves are now heavily exposed to the crashing tech sector.
When those highly leveraged tech loans default because AI wiped out their business models, it severely impairs the life insurers in Bermuda. If the life insurers go down, or even just take massive losses, they stop buying U.S. mortgages. The liquidity for your local bank to offer you a loan instantly disappears. Is your home loan really depending on the survival of offshore shadow banks? Yes. Yes, it is.
What about the physical house itself? Let's look at the property insurance collapse. The real estate analytics firm Cotality projects a massive 16% spike in homeowners insurance premiums over the next 2 years alone.
People focus solely on finding the lowest interest rate, thinking everything else is secondary. But a low mortgage rate is completely useless if climate risks or reinsurance collapses make the house uninsurable.
Let's explain reinsurance quickly. When your local insurance company writes a policy on your house, they don't hold all the risk. They buy insurance for themselves from massive global reinsurers to cover catastrophic events like hurricanes or wildfires. If those global reinsurers take massive losses elsewhere, they raise their rates on your local provider, who then passes that 16% spike directly to you.
That spike will absolutely destroy your monthly debt-to-income ratio if you aren't prepared. By executing a cash-out refinance now, you can fund climate-resilient home upgrades like a new roof, storm windows, or fire-resistant landscaping to mitigate those catastrophic future insurance premiums before they make your home totally unaffordable to hold. Why worry about saving pennies on the interest rate while your house is exposed to catastrophic uninsurability?
Then there is the logistics war tax. The Korea International Trade Association, KITA, issued a warning in the papers you brought over that overland alternative roading to avoid conflict zones will cause shipping costs to surge by 50 to 80% globally.
Every physical good you buy, from furniture to electronics, is going to cost more. Locking in a fixed-rate mortgage is the only way to anchor your primary household expense against this massive global logistics failure.
And it's squeezing our allies, too, which blows back on us. Look at the liquefied natural gas, the LNG, squeeze. With Qatar's LNG exports paralyzed by the regional conflict, massive Asian manufacturing hubs are facing extreme power rationing. Factories are shutting down.
This supply chain freeze will severely constrain the global flow of physical goods, driving immediate consumer inflation back up in the U.S., just like we saw during the pandemic shortages. The Fed will have to respond with a hawkish stance to kill demand. Today's rates are the lowest point of this news cycle.
Furthermore, the U.S. government itself is about to crowd you out of the capital markets. Defense capital crowding is a very real mathematical threat. The U.S. military recently depleted 25% of its Theaid missile interceptor stockpiles due to global engagements. These are incredibly sophisticated systems. It takes up to 8 years and billions of dollars to replace them.
The federal government is going to have to mandate massive deficit-funded defense spending, monopolizing private credit markets to fund the military-industrial base.
You think the U.S. military's strength economically insulates us. But the government has to borrow trillions of dollars to replace the interceptors they just fired. That massive borrowing crowds you out of the credit market. There's only so much capital to go around. If the government is taking it all to build missiles, there is none left for your home loan.
If you don't secure your consumer mortgage now, you're going to pay a missile replacement tax in the form of an 8 or 9% mortgage rate down the line.
And remember, Fannie Mae and Freddie Mac. The GSE risk transfer exposure is a ticking time bomb. GSE stands for Government-Sponsored Enterprise. They guarantee the vast majority of U.S. mortgages. But they don't hold all the risk either. They have $3.3 trillion tied to offshore reinsurance through credit risk transfer programs.
If the software debt crisis and geopolitical shocks break those offshore reinsurers we talked about earlier, Fannie and Freddie will instantly hike your guarantee fees to cover their exposure. They will pass the cost of the global collapse directly onto your closing costs. You need to refinance today before those systemic losses are priced into your loan.
We also need to look at the timeline of all this. The macroeconomic models you provided predict the 2029 Great Convergence. Regional price floors are forming right now ahead of a projected structural recovery phase that economists agree won't hit until roughly 2029.
We have years of grinding ahead. Consolidating your debt today positions your household balance sheet to survive this multi-year trough, so you can actually capitalize on the wealth accumulation phase when it finally arrives at the end of the decade.
The inflation is already being exported from the conflict zones directly to consumers. The UAE just announced petrol price spikes, directly linking the increase to regional missile threats affecting their refineries. Middle East conflicts are exporting immediate inflation globally. Inaction leaves your family exposed to these compounding global war taxes that are completely out of your control.
And if you're thinking, well, if property taxes, insurance, and costs get too high, I'll just sell the house and rent an apartment for a while, I want you to be very, very careful with that line of thinking. Look at the rent control contagion spreading across the country. In places like Los Angeles, strict 4% rent caps were passed to help tenants.
But what actually happened? It stopped new apartment construction by 70%. Developers simply won't build if their returns are capped below inflation. That creates a brutal engineered housing shortage.
If you sell your house, you are stepping into a rental bloodbath where prices on available units are going to skyrocket because there is zero new supply being built. Doesn't keeping your fixed mortgage and riding out the storm seem like the only sane option?
That transitions us perfectly into the fourth section of the data: the commercial real estate contagion and localized protection. We need to understand how commercial corporate failures in your city bleed directly into your residential appraisals, creating a very tight closing window for you to leverage your peak equity.
Try a little more of the CD. It's incredible with the gravy. Let's talk about the office vacancy bleed. You see it driving around. Google just shed 1.4 million square feet of office space. Premium corporate hubs like Playa Vista in LA are sitting at 22.5% vacancy.
You might think your house is in a great, quiet residential neighborhood, so commercial real estate problems downtown don't affect you. But everything is connected. When the tech offices sit empty, the highly paid workers leave. Then the local coffee shops and restaurants close.
Then the commercial property values plummet, which means the city's commercial tax base collapses. How does the city fund your local schools, the police, the fire department? They have to raise residential property taxes or cut services. Either way, your residential home appraisal, which is based on that local economic ecosystem and school quality, takes a massive hit. Debt migration now secures your equity before that commercial blight drags down your neighborhood's valuation.
And the only thing keeping your residential home value high right now is the handcuffed inventory illusion. Nearly 69% of American homeowners are trapped in sub-4% mortgages from the pandemic. Nobody wants to sell their house and lose that low rate, which creates artificial scarcity on the market. Low supply means high prices.
But life events don't care about interest rates. Divorce, death, job loss. The 3Ds of real estate happen regardless of the macroeconomic environment. People eventually have to sell. Extract your equity now before a severe recession forces mass liquidations. When those distressed sales hit the market, it will crush that artificial scarcity and drop your home's comparable price overnight.
We mentioned this earlier with the rent caps, but the multifamily construction plunge is a massive local factor. A 70% drop in new apartment construction ensures rents will remain incredibly high for the foreseeable future. Keeping your home and refinancing your external credit card debt into it is your ultimate shield against this engineered rental housing shortage.
You also need to watch out for the zombie foreclosure deception in the data. The headline data from the news says zombie foreclosures, meaning vacant, distressed properties rotting in neighborhoods, are sitting at a historically low 3.27%. That sounds great. The neighborhood looks fine.
But look at the underlying data on the next page. Total foreclosure filings, the early stages of the legal process, are actually up 32% year over year. The normalization of defaults is happening behind closed doors right now. You need to secure your financing before those regional defaults spike publicly, and make your local lenders hyper-conservative about lending in your zip code.
And don't be fooled by the Dream for All subsidy bubble. Programs like California's CalHFA are resuming, injecting state-sponsored shared equity subsidies into the market to help first-time buyers.
People think organic first-time buyers are keeping their property values high. The reality is that your entry-level home's value is currently being propped up by taxpayer subsidies. It synthetically inflates demand. It is an artificial price floor.
If the government is artificially inflating your home's value with taxpayer money, shouldn't you cash out on the government's dime while the program is still funded? When that state funding inevitably runs out, the floor drops. Capitalize on this synthetic demand to restructure your debt today.
Now look at the corporate side of the real estate data. The enterprise multiple collapse. This is crucial. Corporate valuation multiples have violently compressed from 9 times down to roughly 6 times.
Let's explain the enterprise multiple. It is a company's total enterprise value divided by its earnings. A shrinking multiple means the market values the company significantly less than it used to. This is accelerating a $215 billion maturity wall of corporate real estate debt that is coming due soon.
You assume banks have plenty of money to lend and you can just refinance your house whenever you feel like it. But banks have this $215 billion wall of corporate debt they have to manage. When these massive corporations need to refinance their office buildings just to survive, they will siphon all available capital from the banking sector.
The banks are going to save their massive multi-million-dollar corporate accounts over Jim's residential mortgage. When the residential capital well runs dry, you won't get a loan at any rate. By locking a 30-year agency loan today, you bypass this upcoming corporate refinancing bloodbath. Why assume the bank will prioritize your family next year?
At the local level, we are also seeing the end of subsidized utilities for landlords. Rent control updates in major cities are eliminating utility allowances, which violently compresses landlord profit margins. If a landlord can't make a profit, they stop maintaining the building. This leads directly to property decay and urban blight. Homeownership, locked in with a fixed mortgage, is the absolute only way to control your living standards in a degrading urban environment.
We are also tracking a massive flight from coastal tech hubs like Silicon Beach and LA. The high-income tech buyer pool is evaporating due to the AI displacements we discussed, and displaced millennials are retreating to the rental market or moving inland. This signals a very top-heavy residential market. If you hold equity in a premium coastal market, the cost of inaction is watching that equity evaporate as the high-income buyers simply disappear.
It's not just domestic buyers leaving. We are seeing global real estate reallocation. As capital flows out of the U.S. and into emerging markets, the foreign cash buyers who historically propped up coastal real estate valuations buying properties sight unseen are going to vanish. You need to lock your loan based on today's inflated foreign-backed appraisals before those comparable sales disappear from the neighborhood data.
Finally, look at the agricultural land consolidation happening inland. The new Farm Bill expanded loan caps, which signals sustained rural inflation. As rural agriculture becomes heavily corporatized and land becomes more expensive, it pushes displaced rural populations and demand into suburban corridors. Secure your suburban financing now before this rural exodus spikes your local housing competition and drives prices further out of reach.
Think about the rate lock hostage situation again. I hear people say they are financial geniuses for never touching their 3% mortgage. But ask yourself, why would someone hold a trophy 3% rate on the wall while they are simultaneously drowning in $40,000 of credit card debt compounding at 24%?
Are you keeping a trophy rate to brag at parties while your family bleeds cash every single month, paying minimums to Visa and MasterCard? You are stepping over dollars to pick up pennies.
And regarding the 2029 waiting game, people sit at this table and say, I'll just wait for the market to go back to how it was in 2021. We already established that a structural recovery won't hit until 2029. We have 3 to 4 years of severe economic grinding ahead of us. Are you going to white-knuckle variable interest rates, losing sleep every night for 38 straight months? Or are you going to fix your costs today and actually sleep soundly?
This leads us to our final core section of the data, Section 5, the strategic execution and the illusory wait for Fed cuts. We have to completely dismantle the media narrative that the Federal Reserve is going to swoop in on a white horse and save the consumer.
Pour the last of that Barolo. We need to face facts. The neutral rate trap is real. The Fed is currently holding its benchmark rate flat at roughly 3.50 to 3.75%.
Let's define the neutral rate. It's the theoretical interest rate that neither stimulates nor restricts the economy. It's the Goldilocks rate. For the last decade, we thought the neutral rate was near zero. The era of cheap liquidity is over. The Fed has realized that the new theoretical neutral rate has permanently shifted upward. Current mortgage rates around 6% are the new baseline, not a temporary spike. Waiting for pandemic-era rates is a delusion that is costing you thousands in consumer interest every month.
Listen to the smart money. The JP Morgan report in your stack is crystal clear. Their analysts project zero rate cuts for 2026. Zero. Refinance today to optimize your liabilities before the secondary bond markets fully price in this hawkish, higher-for-longer reality.
The Fed is caught in an impossible paradox: AI deflation versus energy inflation. Think about it. AI is destroying jobs and lowering corporate costs, which is highly deflationary. But the Hormuz blockade and supply chain collapses are driving oil to $130 and goods higher, which is massively inflationary. The central bank is completely paralyzed. They cannot cut interest rates without igniting runaway energy inflation, and they cannot raise rates without completely crushing the fragile labor market. Securing a fixed mortgage now is your safest play in a completely paralyzed monetary environment.
And it gets messier. Look at the DOJ distraction. There is an unprecedented grand jury probe into Fed Chair Jerome Powell. Now, regardless of your politics, regardless of who is in the White House or what you think of the Department of Justice, we have to look at how the bond market reacts.
The bond market hates uncertainty.
This probe injects a massive chaos premium into bond yields. Institutional investors demand higher yields when central bank independence is threatened by political instability. Lock your loan before Washington's chaos makes borrowing totally unaffordable. You're paying the price for their dysfunction. The Fed is also debating the MBS roll-off threat. Internal Fed minutes confirm they are evaluating how to unwind their massive portfolio of mortgage-backed securities. During the pandemic, the Fed bought trillions of dollars of mortgages to keep rates artificially low. Now they want to shrink their balance sheet. If the Fed stops buying mortgages and starts dumping their inventory onto the open market, consumer mortgage rates will aggressively detach from standard Treasury yields and spike even higher. Today's rates are the absolute floor.
We also have tariffs versus the Fed. We mentioned Section 122 tariffs on construction materials. These act essentially as a 10 to 15% consumption tax on the American public. The Fed is legally obligated to fight this imported inflation by keeping their benchmark rates high. The cost of inaction is fighting the U.S. government's tax policy using your personal credit cards. You will lose that fight.
Look at the break-even window math. People refuse to refinance because they think the rate drop isn't big enough. But the math proves that a mere 0.75% rate drop justifies refinancing on a 36-month break-even timeline, especially when you roll in high-interest consumer debt. Do not let the pursuit of a perfect interest rate blind you to the massive, immediate mathematical savings available today by dropping your rate just 3/4 of a point and paying off your external debt.
Avoid the target fixation trap. I hear clients say they won't refinance until rates hit exactly 4.99%. But while you wait 18 months for that magical psychological number, your credit card debt is compounding at 24%. You are spending $500 a month in credit card interest just to maybe save $100 a month on a future mortgage rate. Again, stepping over dollars to pick up pennies.
Furthermore, the Kevin Warsh nomination for Fed chair injects massive policy uncertainty. The administration hopes he will align the independent bank with the White House's vision. Whether he does or not doesn't matter. Markets despise uncertainty and will aggressively price that risk into your mortgage rate. Lock in certainty today before the confirmation hearings create market chaos.
Here is a huge tactical advantage for you right now: eliminating zombie PMI. PMI is private mortgage insurance. You pay it every month if you put less than 20% down when you bought the house. It protects the bank, not you. Because current home valuations are artificially high right now due to the supply constraints we discussed, your house is likely worth much more on paper than when you bought it. Executing a refinance now might allow you to show 20% equity and completely remove that private mortgage insurance.
That is the PMI evaporation. You might think a refinance only makes sense if the headline interest rate drops drastically. But if you drop your rate slightly, roll in your credit cards, and instantly delete a $200 a month PMI payment, that is a massive immediate win. Are you going to let the bank bleed you dry every month for insurance you no longer mathematically need to pay? That is pure cash flow back into your pocket every single month.
Finally, we have to look back at the sovereign gold signal. As we said, central banks fleeing to $5,400 gold means they are anticipating systemic dollar instability. Taking on a larger 30-year fixed mortgage right now might feel like taking on too much debt.
But a 30-year fixed mortgage is the ultimate short on the US dollar.
Exactly. Explain the short concept. When you short a stock, you are betting it will go down in value. When you take a 30-year fixed mortgage, you are shorting the US dollar. As inflation destroys the value of fiat currency over the next 3 decades, your fixed debt mathematically shrinks in real terms. You are paying back the bank with dollars that are worth a fraction of what they were worth when you borrowed them. The bank is actually the one taking the massive risk by lending you fiat currency that is losing its value. You are locking in a tangible asset, your home, while shorting the currency. It is the greatest wealth preservation tool available to the middle class.
The Fed's handcuffs are locked. People think Powell is going to aggressively cut rates to save the housing market. But Powell's trapped in a burning building. If he cuts rates, energy prices explode and inflation roars back. If he hikes rates, the private credit market defaults. He literally cannot save you. If you were waiting for him to lower your rate, you are waiting for a rescue ship that has no engine. Are you really betting your family's finances on a paralyzed government entity?
Dinner is over. Let me clear these plates. Bring them into the kitchen for me. I'm going to bring out something special. I'm pouring us a neat measure of this Amaro Montenegro. Drink this. It settles the stomach, and trust me, after everything we just talked about, you are going to need it.
We covered the grand scheme, the macro narratives, the matrix of what is happening. But to truly survive this meat grinder, to really protect your household, you need to know the granular details, the specific mechanics buried on page 12 of the Keta reports and the SCOTUS filings that everyone else glossed over. This is the extra episode, Things You May Have Missed.
Let's start with the SCOTUS details on that tariff ruling. It wasn't just a simple stroke of the pen by the Chief Justice. It was a vicious, highly technical 6-3 divide. Roberts, Gorsuch, Barrett, Sotomayor, Kagan, and Jackson struck it down, strictly separating taxation powers from emergency commerce controls. But Kavanaugh, Thomas, and Alito wrote a scathing dissent, warning it would destabilize trillions of dollars in bilateral trade pacts.
And because of that split, corporations are now stuck in an administrative nightmare. To get their tariff refunds, they have to file what are called post-summary corrections, PSCs, for unliquidated port entries. If the entries are already liquidated, they face protracted, years-long litigation in the Court of International Trade. It is total administrative gridlock. Billions of dollars are trapped in legal limbo. And the Cato Institute noted this specific gridlock represents a $2,600 tax offset loss per American household. That is hidden inflation coming straight out of your pocket.
And the Middle East. That kinetic strike wasn't just a one-off military operation. It created a massive power vacuum in Iran. The strike triggered a new triumvirate taking over the government via Article 111 of their constitution. President Pezeshkian, Chief Justice Mohseni Ejei, and a jurist from the Guardian Council.
Why did the strike happen right at that specific moment? Because intelligence showed they were triggered to interrupt a €500 million delivery of advanced Russian Su-35 fighter jets to the regime. This isn't just regional skirmishing. This is a highly calculated, entrenched escalation involving global superpowers. That guarantees the geopolitical risk premium on oil is permanent. It is not going away next year.
Then there is the secondary tech carnage that didn't make the front pages. Everyone talked about IBM and Google, but the bleeding went deep into the service economy. LegalZoom's stock fell 20% because AI can now write basic contracts. RELX, the massive data analytics firm, fell 14%. eBay isn't just cutting domestic jobs. They are actively offshoring the remaining corporate roles to India and Ireland to save costs.
But even offshore isn't safe from the AI displacement. Indian IT services, which have been the backbone of global corporate outsourcing for 2 decades, saw their sector crash 21% in just 4 weeks. AI is wiping out the outsourced jobs just as fast as the domestic ones. Over $16.3 billion of institutional wealth fled those sectors and parked into safe haven U.S. Treasuries out of pure panic.
Finally, let's hit the hyper-local data for Los Angeles that you brought, just as an example of what's happening on the ground in major markets. The pre-crisis baseline median home price was $890,910. The county just lost 16,300 jobs in a single quarter. Yet, entering to premium markets like Silicon Beach is still a staggering $2 million to $4 million.
Sure, massive upcoming events like the 2026 World Cup and the 2027 Super Bowl will temporarily boost short-term rental income for local landlords. But the residential market itself will not revert to its healthy, historical mean of roughly 110,000 annual transactions until 2029. We are in for a long, grinding freeze, where transactions are incredibly rare and financing is heavily restricted.
So what does this all mean for you sitting across this table from us right now? It means you have to stop acting like a spectator watching the news happen to you. You must step up and become the chief financial officer of your household. A CEO does not sit on their hands and wait for the Federal Reserve to come save their corporate balance sheet. When inflation runs hot and credit markets start to freeze, the smart money takes action. They consolidate their variable liabilities into a 30-year fortress.
That is the absolute bottom line. You take control. You migrate your volatile variable debt into the safest, most subsidized harbor left in the American economy, fixed-rate residential real estate. You cut the monthly bleeding from your credit cards, you eliminate the zombie PMI, and you mathematically secure the cash flow your family needs to survive until 2029.
The window to execute this is closing. Don't white-knuckle this economy. Take the data we walked through tonight, look at your family's balance sheet without emotion, and execute the plan. Drink the rest of that tomorrow. We'll see you in the trenches tomorrow.